Silver just made a move that doesn't belong in calm markets. While most people were asleep, it didn't grind higher. It didn't probe resistance. It launched straight up, fast, violent. The kind of move that makes shorts panic and makes longs stare at the screen wondering if what they are seeing is real. And here's the part that should bother you. This doesn't look like a normal panic. It looks organized without being planned, like two sides stepping back at the same time and accidentally lighting the fuse. It's Tuesday, January 27th, just after 5 in the morning in New York. And what happened overnight matters far more than a single candle on a chart. Because if you think this is just a technical move, you're already behind. Silver opened in the low 100s and simply didn't stop. It pushed higher, pressed through levels, and traded up into the 1 to 10 zone. Then Asia came back online, and Shanghai didn't follow. It overshot. Prices there spiked well above U.S. futures before cooling off. That spread is where the story changes. When Shanghai pays a large premium to U.S. prices, it signals urgency, real physical demand concentrated in one place. When that premium compresses, it usually means either demand is fading or the cheaper market is being dragged higher. Last night, the sequence was clear. Asia lit the match. The premium widened. Then it compressed, not because buying vanished, but because U.S. prices rose into it. That's not contagion. That's force. Naturally, people want a villain, a single lever, a clean headline. One camp says a major U.S. bank is trapped. Another says China is desperate for metal and getting squeezed. Those stories can't both be true in the way they're being sold. Markets don't move like movies. What I see instead is defensive behavior, massively defensive behavior, by multiple players at once. Not a coordinated squeeze, but a shared realization. In a world where supply chains can be sanctioned, rerouted, or simply broken, you don't wait for inventory. You secure it, even if the price hurts. That's the difference between speculators and real users. Speculators care about price. Real users care about availability. And availability is the real battlefield right now. Look at who gets hurt first. At these prices, silver is a problem for industries that rely on it. Solar manufacturing is a prime example. Even as silver use per panel declines, scale overwhelms efficiency gains. When silver spikes, costs spike, margins get squeezed. So buyers don't wait. They pull orders forward. They lock in supply. The same applies to electronics, medical uses, and countless quiet industrial applications people forget about. Industrial demand doesn't need to dominate total demand. It just needs to be inelastic. If factories need silver to fulfill contracts, they pay up. The buying doesn't ask permission. Here's the uncomfortable shift people are missing. For years, investors were assumed to lead and industry to follow. But what if that's flipped? What if industry is front-running the public because it has no choice? If that's true, selling the spike becomes dangerous because the bid underneath isn't hot money. It's procurement desks, and they don't care about Fibonacci levels. Now layer in the financial system. Silver flows through futures, options, clearinghouses, bullion desks. When price moves like this, anyone with large short exposure feels stress. That doesn't mean one bank implodes overnight. Real stress is rarely that cinematic, but disruption is expensive. Even if firms hedge or trade around it, clogged plumbing taxes the entire system. And here's what most people miss. Both sides can be hurting at the same time. China absorbs higher industrial costs. U.S. financial institutions absorb market stress. Nobody has to be winning. They're just minimizing damage. Zoom out further, and silver stops looking like a metal and starts looking like geopolitics. Silver sits at the intersection of money, industry, and security, right alongside copper, oil, and rare earths. When supply chains become strategic assets, stockpiling becomes defensive behavior. Nobody waits for laws to pass. They move early. They lock supply. That's how you get explosions without masterminds. Everyone retreats at once, and here's the warning hidden in the Shanghai premium. Arbitrage only works if metal can move. When logistics, export rules, financing, and delivery constraints get in the way, the spread closes the hard way. The cheaper market gets pulled up. That's not paper stress. That's physical urgency. And if the constraint is logistics, it doesn't resolve with a dip. It resolves with time. The one thing panicked buyers don't have. Silver supply can't respond quickly. Much of it is a byproduct of other mining. You can't flip a switch. Recycling helps, but it has limits. That fragility matters when demand surges. So if industry wants security and investors want insurance, the same ounce gets chased for two different reasons. That's when price overshoots. This isn't a clean US versus China tug of war. Commodity inflation is a boomerang. Squeeze inputs too hard and you raise costs for yourself. The real question isn't who can outspend whom. It's who can absorb the second-order damage without breaking something critical. Watch the spreads. Watch whether gains hold or fade. Watch procurement headlines, inventory adjustments, and quiet policy language around critical minerals. Most of all, separate paper demand from physical stress. Paper moves fast and reverses fast. Physical stress turns markets into supply chains. Silver looks liquid until it doesn't. So ask yourself this. If this was only the first wave of securing supply, what happens when the second wave hits and the public realizes the shelves are already thinning? That's the moment I'm watching for. Do you think this silver move is mostly industrial panic buying, or is it financial positioning unwinding? Think about it, because the answer matters, and it might tell you who's really driving the market. Let's do the morning rundown, because the numbers matter, but the relationships matter even more. Yields on the 10-year are modestly lower. The dollar is softer. Equity indexes are mixed, leaning positive. Volatility is up. Stocks climbing while volatility rises doesn't mean all is fine. It means someone is paying for protection. Gold is ripping, decisively breaking a major psychological level and holding above it. Silver is the headline, trading around 110 with a strong overnight gain. Shanghai silver is still at a premium, even after cooling from its highs. Copper is up. Oil is slightly down. Natural gas is higher. Crypto is up. Other precious metals are higher. Grains are mixed. Here's the cliffhanger. If this were just risk on, why is gold acting like the world is on fire? Exactly. That's why you can't look at a single chart. Now let us zoom out to the bigger story explaining why gold and silver aren't just trading, they being repriced. A macro framework making the rounds compares the current setup to the mid-1970s, big fiscal spending, intervention risk, and inflation returning in waves rather than a clean cycle. If you weren't investing back then, here's why that comparison freaks people out. In the mid-70s, inflation didn't march in a straight line. It came in bursts. Policy tightened, the economy slowed, everyone declared victory. Then prices reaccelerated when stimulus collided with energy shocks. Markets swung between growth returning and the currency weakening faster than portfolios could adjust. Gold back then didn't behave like a sleepy hedge. It acted as a stress gauge. When confidence wobbled, it responded. When real interest rates dipped, it responded again. Commodities, especially industrial and energy metals, followed because the world was still building, still consuming, even amid chaos. That's why the second wave concept matters. If inflation returns in pockets, stocks can look fine on the surface while purchasing power quietly erodes underneath. That's a perfect setup for metals to move before the public understands why. And it explains why silver can go from ignored to unavoidable in a heartbeat. Silver is tied to growth and to protection, dual purpose. When the world feels stable, it's an industrial input. When instability rises, it's suddenly monetary history too. So, in a wave environment, the question isn't whether volatility disappears, it's whether volatility becomes the default setting. The takeaway isn't to hide in cash, it's to rotate. Stay exposed to growth, but shift where you're exposed. Less concentration at the top, more diversification across the middle and edges. Bonds remain a question mark until long yields convincingly break one way or another. History doesn't repeat exactly, but it rhymes. And that changes how big money thinks about hedges. Which brings us to the second story, how macro actors behave. Big institutions, Daunt IT, usually lead a trade with a press release. They join after it. It's already moving for confirmation and cover. So when you see broad convergence around gold as the hedge of choice, that can mean one of two things. The trade is crowded and vulnerable, or the regime has changed and the crowd is late. Silver, it seems, already knows the answer. Third story, the global drumbeat around physical gold custody and repatriation is getting louder. When countries start asking where their gold is and how fast it can move, this isn't a retail story, it's a trust story. And trust stories don't end quickly. Fourth story, U.S. policy momentum is building around critical mineral stockpiles with serious funding attached. That signals official recognition that supply chains are strategic, not just economic. And if governments are stockpiling, private players are already stockpiling too. That's the pattern. Now let's talk silver targets and reality. Is this the top? A blow-off? I won't pretend to call the exact tick, but when a market rips like this, two risks emerge. One, the obvious. You chase it, it pulls back, you panic. Two, the sneaky. You assume it must pull back, sit it out, and never get the entry you wanted. Instead of playing fortune teller, focus on structure. If silver holds a chunk of this move, consolidates, and pushes again, that's not a blow-off, that's repricing. Another angle people often miss, above-ground silver inventories aren't infinite. There's a difference between silver existing and silver being available at scale, deliverable, and unencumbered. A lot is tied up in long-term holdings, industrial products, or financial claims. Free float can be thinner than people think. That's why sudden surges happen. And here's where the bigger play comes in. Silver, copper, oil, rare earths, they're all connected. Imagine rare earth supply restricted, critical inputs weaponized through export controls, energy becoming a bargaining chip. Nations negotiate through pressure points, not press conferences. There's no mastermind manipulating silver. And what we're seeing is an era of strategic competition, real-world hoarding, real-world policy moves, pushing markets around, sometimes violently. Silver is especially sensitive. It's everywhere. Stockpiles are hard to build quietly, and sudden demand is amplified. If two major players decide to secure supply, the market doesn't care who's right, it just runs. Let's address China. Could industrial demand plus strategic stockpiling create urgency? Sure, but paying isn't the same as solving the problem. Delivery matters, channels matter. If access could tighten, buying early tightens access for everyone else. That's the trap. And the US bank narrative? Parts of the financial system could be stressed by sudden repricing and leverage, but the market doesn't need a single failure. It just needs the perception of tightness and reflexive buying. Multiple players are being squeezed by the same reality, not each other. When everyone acts in self-interest simultaneously, price becomes the referee. Here's a key point. Spreads and gaps reveal disorder. If one market gaps and another doesn't, it shows the buyer at the margin. Right now, Asia looks like the buyer at the margin. If that buyer keeps paying after the spike, what happens when the public notices? That's when things get interesting. Retail doesn't lead, but late arrival can turn repricing into a frenzy. Watch the structure. Watch spreads. Watch physical indicators. Watch policy. Now, the broader backdrop, a weakening dollar and drifting yields normally give metals a lift. But metals moving like this while the world pretends everything is fine? That's not normal. Gold above major round numbers signals insurance. Silver ripping shows that insurance premium is being repriced. Copper firm tells you the real economy still needs inputs. Oil volatility tells you energy isn't solved. Pair that with policy chatter about stockpiles, and the market stops behaving like a spreadsheet. It starts behaving like a battlefield. Final cliffhanger. Will the next move come from supply disruption or financial stress in paper markets? Both? Watch closely. At the core, silver didn't explode because someone trapped someone else. It exploded because everyone is scared of being last to secure supply. China isn't necessarily crushing a US bank. A US bank isn't necessarily crushing China. What's happening is a global retreat into resources. Everyone is hoarding, everyone is acting in self-interest. And if it continues, silver can become a bargaining chip in a much larger negotiation that includes copper, oil, and the minerals powering modern technology. Not guaranteed? No. Worth thinking about? Absolutely. The right question isn't what makes us comfortable, it's who benefits and who suffers. Pay attention. The next headlines may not be about price, they'll be about access. Deliveries, inventories, and spreads are the real story. Everything here is for education and discussion. I'm not your financial advisor. Use this to think better, see the structure, and understand the forces shaping the market.